Did you know that over the past 95 years, the US stock market has returned an average of 10% annually? This is despite numerous recessions, world wars, and global crises. This remarkable statistic highlights a powerful truth. The stock market over the long term has consistently trended upwards. This upward trend is not a guarantee of future returns. However, it showcases the potential of long-term investing. By harnessing the power of compounding, even small investments can grow significantly over time. Imagine a single dollar invested in 1929. With an average 10% annual return, it would be worth over $2,800 today. This simple example underscores a crucial point. Time plays a vital role in investment success. While past performance is no guarantee of future results, history shows us the remarkable potential of remaining invested for the long haul. It is in the face of short-term fluctuations that we must remember the power of patience and the long-term growth potential of the market. This brings us to a key question. Why is long-term growth in the stock market so crucial for investors? Long-term growth in the stock market is essential for several reasons. Firstly, it helps investors build wealth over time, outpacing inflation and securing their financial future. Investing in companies allows you to participate in their growth and profitability. This participation translates to potential increases in your investment's value. Secondly, long-term growth is vital for reaching significant financial goals. These goals may include buying a home, funding a child's education, or retiring comfortably. By investing consistently and patiently, individuals can accumulate the substantial funds needed to achieve these milestones. Lastly, long-term investing promotes financial discipline and reduces the impact of emotional decisions. By focusing on the long-term horizon, investors are less likely to react impulsively to short-term market swings. This disciplined approach can lead to better investment outcomes in the long run. However, the journey to long-term success in the stock market is not without its challenges. Investors often face obstacles such as market volatility and the complexities of emotional decision-making. Let's explore these challenges in more detail. The stock market, by its very nature, is prone to fluctuations. These fluctuations, often driven by economic news, political events, or investor sentiment, can be unnerving for even the most seasoned investors. Market volatility is a fact of life for anyone participating in the stock market. However, it's crucial to remember that volatility is not inherently bad. In fact, it presents opportunities for savvy investors. After the latest hot stocks, only to see their value plummet when the hype subsides. Overcoming these emotional pitfalls is essential for long-term success. So, how can investors navigate these challenges and position themselves for long-term gains? Let's delve into some key strategies. One of the most effective strategies for mitigating risk and enhancing long-term returns is diversification. Diversification involves spreading your investments across various asset classes, sectors, and geographies. This approach aims to reduce the impact of any single investment on your overall portfolio. Imagine your portfolio as a basket of eggs. If all your eggs are in one basket and you drop it, you risk breaking them all. However, if you distribute your eggs across multiple baskets, the impact of dropping one basket is significantly reduced. Similarly, by diversifying your investments, you cushion your portfolio against the volatility of any single stock or sector. If one investment performs poorly, others can potentially offset those losses. Diversification helps to create a more resilient portfolio, capable of weathering market storms and delivering steadier returns over time. But diversification is not just about spreading your bets. It's about strategically allocating your investments across different asset classes with varying risk and return profiles. This brings us to another crucial strategy: dollar cost averaging. Dollar cost averaging is a powerful strategy that involves investing a fixed amount of money at regular intervals regardless of market conditions. This approach takes advantage of market fluctuations to potentially lower your average cost per share over time. When prices are high, you buy fewer shares. When prices are low, you buy more shares. This systematic approach helps to smooth out the ups and downs of the market and potentially enhance your long-term returns. Dollar cost averaging also offers a psychological advantage. By investing consistently, regardless of market sentiment, you avoid the emotional trap of trying to time the market. This disciplined approach can lead to greater peace of mind and potentially better investment outcomes. However, investing without understanding the broader market context can be like sailing without a compass. That's why it's crucial to grasp the concept of market cycles. Market cycles are periods of expansion and contraction that characterize the economy and financial markets. Understanding these cycles is crucial for making informed investment decisions. During periods of economic expansion, businesses thrive, corporate profits rise, and stock prices tend to climb. Conversely, during economic contractions, businesses struggle, profits decline, and stock prices often fall. Recognizing where we are in the market cycle can help investors make more strategic decisions. For instance, during periods of market euphoria, it might be wise to exercise caution and avoid chasing after overvalued assets. Conversely, during market downturns, opportunities may arise to purchase undervalued stocks with strong long-term potential. While diversification, dollar cost averaging, and understanding market cycles are all valuable strategies, there's one particular strategy that stands out for its potential to supercharge long-term growth. Reinvesting dividends is a powerful strategy that can significantly amplify your long-term returns. Dividends are payments made by companies to their shareholders, typically in the form of cash or additional shares. Instead of pocketing those dividends, reinvesting them allows you to purchase more shares of the company. This, in turn, generates even more dividends in the future, creating a snowball effect known as compounding. Over time, this compounding effect can lead to exponential growth in your investments. Imagine a snowball rolling down a hill. As it gathers more snow, it gets larger and larger, picking up speed and momentum. Similarly, reinvested dividends can supercharge your portfolio's growth over time. Numerous studies and historical data demonstrate the power of dividend reinvestment. Companies that consistently pay and increase their dividends have historically outperformed their non-dividend paying counterparts over the long term. In conclusion, achieving long-term success in the stock market requires a combination of knowledge, discipline, and a long-term perspective. By embracing the strategies outlined in this essay, investors can navigate the complexities of the market and position themselves for financial growth. Remember the importance of diversification to mitigate risk and build a resilient portfolio. Embrace dollar cost averaging to master time in the market and potentially lower your average cost per share. Understand market cycles to make more informed investment decisions based on the broader economic context. Above all, harness the power of compounding by reinvesting your dividends. This simple yet powerful strategy can supercharge your returns and propel your portfolio to new heights over time. Investing in the stock market is a journey, not a sprint. By staying focused on your long-term goals, remaining disciplined in your approach, and continuously learning and adapting, you can increase your chances of achieving financial success. Now that you've gained insights into unlocking long-term stock market success, we'd love to hear from you. Share your investing experiences, challenges, and triumphs in the comments below. What strategies have worked best for you? What lessons have you learned along the way? Your insights can inspire and educate fellow investors on their financial journeys. Remember, the world of investing is vast and ever-evolving. Continue to explore new strategies, stay informed about market trends, and never stop learning. The more you know, the better equipped you'll be to navigate the complexities of the market and achieve your financial goals.